Welcome to the deep dive. We're going to really get into the market analysis you shared with us.
Yeah, the one covering the U.S. stock market, looking at today and tomorrow, May 26th and 27th, 2025.
Exactly. And our goal here really is to cut through some of the noise, make sense of maybe conflicting signals you might be seeing out there.
Especially given the market dynamics.
Right. We know the U.S. markets were closed yesterday for Memorial Day, Monday the 26th, so futures action and the outlook for Tuesday become, well, pretty critical.
Absolutely. It's all about reading those early signs. So where should we start?
Well, the analysis kicks off by revisiting some big picture macro assumptions. First up, inflation. The April CPI numbers, they seem a bit contradictory, don't they?
They really do. You've got the headline CPI, the main number, showing this moderation. It was up only 0.2% for the month, 2.3% year over year. That's actually the smallest 12-month increase since, early 2021.
Sounds positive on the surface.
It does. But then you dig into the core CPI, that's the one stripping out food and energy, and it's stickier. It was also up 0.2% month over month, but still 2.8% year over year.
Still quite a bit above the Fed's target.
Exactly. And it's being driven by things like shelter, still up 4% year over year, and services costs.
Yeah.
So the nuance here for you is, headline looks better, but the stuff the Fed really watches, that core inflation, still stubborn.
Okay, so headline cooling, core staying warm.
Right.
And the analysis mentions a drop in U.S. productivity in Q1. How does that fit in?
Yeah, that 0.8% fall in productivity, that's not helpful for inflation.
Right.
Lower productivity can mean higher business costs, and those often get passed along to consumers.
Potentially counteracting some of that headline progress.
Precisely. It makes disinflation harder, especially in those service sectors we just mentioned.
Yeah.
So the Fed's going to be watching this core stuff very, very closely. Next CPI is June 11th, so eyes peeled for that.
Now, speaking of the Fed, they held rates steady in May. 4.25% to 4.5%. The analysis calls it a wait-and-see approach.
That sums it up well. Fed Chair Powell basically said the policy stance is in a good place, which, signals they're comfortable pausing for now.
But the analysis also notes they're worried about risks on both sides. Inflation staying high, A&D unemployment potentially rising.
Correct. It's a balancing act.
Yeah.
And trade policy seems to be adding to that uncertainty.
Which leads perfectly into Chicago Fed President Goolsby's comments from May 23rd. He mentioned Trump's tariff threats.
Yeah, he essentially said those threats complicate the Fed's job, makes it harder to figure out the inflation path, and could potentially delay any rate cuts.
So that's a direct link between potential trade policy and monetary policy decisions.
Absolutely. Tariffs could push prices up.
Right.
When the Fed wants them to come down, it adds another layer of complexity. So the market's currently pricing in maybe 2 rate cuts this year, starting September maybe. But Goolsby's comments and the Fed's general data dependency, plus this trade wildcard, it just reinforces that nothing's guaranteed. They'll wait for the data.
Okay, let's shift gears a bit. Earnings. Nvidia reports on May 28th. The analysis calls it a key bellwether. Why is it so critical right now?
Well, Nvidia is just so central to the whole AI narrative, its performance, its outlook. It's seen as a proxy for the health of the entire tech sector, especially AI.
A signpost for that whole space.
Exactly. If Nvidia does well and guides strongly, it lifts sentiment. If it disappoints, it can drag down a lot of related stocks and even broader market confidence.
And the expectations seem pretty high, like almost 20% EPS growth, over 60% revenue growth year over year.
Massive numbers. But, and this is a key point in the analysis, there are whispers of concern about their GAAP gross margins.
GAAP margins. Explain that a bit.
Sure. GAAP is just the standard accounting rules. Gross margin is basically revenue minus the direct cost of making their chips. The analysis projects it might dip to around 70.6%, down from over 78% a year ago.
Okay, why the potential dip?
Could be a couple things. Maybe the extreme scarcity of their AI chips is easing a bit, so pricing power isn't quite as strong. Or, rising competition. Plus, those ongoing U.S. export restrictions to China are still a headwind for them.
So the report isn't just about the headline growth numbers. It's about profitability, competition, and even geopolitical impacts.
You got it. It's a multifaceted test. Any surprise, positive or negative, could really ripple through the market this week.
Okay, so putting the macro and Nvidia together, the analysis outlines 3 scenarios for the next, say, 24 to 48 hours. Scenario 1, the most likely at 55%, is cautious optimism, range-bound, pre-NVDA. Walk us through that.
Right. So the thinking here is the market got a little boost from that news about the EU tariffs being delayed. A bit of relief.
Takes one worry off the table short term.
For now, yes. But investors are still cautious ahead of Nvidia. And the Fed isn't giving any strong, all-clear signals. So the market probably trades sideways, maybe drifts slightly higher, but stays in a range. Focus shifts to individual stocks, maybe some positioning before Nvidia.
Makes sense. Scenario 2, 30% probability. Renewed tariff jitters, hawkish Fed speculation. What triggers this?
This is the flip side. Maybe some new negative headline about tariffs elsewhere pops up. Or maybe some unexpected economic data comes out strong, making people think, uh-oh, maybe the Fed stays hawkish for longer.
Like those sticky core inflation numbers we talked about, or Goolsby's warning.
Exactly. If that sentiment takes hold, you'd expect futures to pull back. Tech and other growth stocks would likely get hit, and money might move into safer assets.
And the third one, just 15% probability. Pre-earnings tech enthusiasm, a pure Nvidia hype play.
Pretty much. This scenario is all about optimism, building specifically around tech, maybe driven by excitement for Nvidia's numbers. You'd see Nasdaq futures likely outperform.
Fueled by AI hopes and maybe Nvidia's track record of beating estimates?
Right, but the analysis suggests this might be more isolated to tech, not necessarily lifting the entire market dramatically.
Okay, so based on those scenarios, what's the overall directional bias for the very near term, Monday morning to Tuesday morning?
The analysis leans neutral to slightly bullish overall. That EU tariff delay helps sentiment short-term, but the Fed caution and the looming Nvidia report cap the upside.
And for the specific indices?
For S&P 500 futures, call it neutral. Support around 5,800, resistance maybe 5,900, 5,950. Nasdaq 100 futures look neutral too. Slightly bullish support near 21,000, resistance around 21,270, 21,300, maybe eyeing 21,500. And the Dow futures also look neutral, support 41,800, resistance 42,000, 42,100.
Got it. The analysis also filters some recent news. The biggest one, as you mentioned, Trump delaying those EU tariffs until July 9th. That's seen as a definite positive catalyst for now.
Huge near-term positive. It clearly helped lift futures sentiment when it was announced on Monday.
Yeah.
Takes away an immediate point of conflict.
But almost in the same breath, we're reminded of Goolsby's comments about tariffs still being a complication for the Fed. It's that push and pull again.
Exactly. Relief on one front, but the underlying issue and its potential impact on inflation and Fed policy haven't vanished. It just tempers the pure optimism.
There was also some commentary from Nvidia's CEO, Jensen Huang, about AI, labor shortages, using robotics, expanding in Taiwan, more long-term stuff, maybe.
Yeah, that's more about reinforcing the long-term bullish narrative for Nvidia and AI. Good context heading into earnings, but probably not driving the market hour to hour right now.
And then just the fact that the cash market was closed Monday for Memorial Day, all eyes on futures.
Right. Lower liquidity in futures means moves can sometimes be exaggerated, but it's the best real-time read we had on sentiment heading into Tuesday's open.
One more specific news item, SoundHound AI. Something about a class action lawsuit deadline today, May 27th.
Yeah, investor alerts about a lead plaintiff deadline. These kinds of legal deadlines can sometimes increase volatility in a stock as investors react or reposition. Definitely something to watch for SOU specifically.
Okay. Zooming out again to the sector view. The analysis suggests that tariff delay gave things a lift, but money seems to be flowing into particular areas.
Definitely seeing some rotation. S&P futures pushed towards 5,900. Nasdaq futures had that strong rally towards 21,270. Dow moved up towards 42,000.
And the favored themes seem to be AI, tech, and defensive sectors.
That's the pattern. With Fed uncertainty and trade worries lingering, investors seem to like the growth story in AI. I think Nvidia, maybe Amazon, but also the perceived safety of defensive sectors like utilities or healthcare. Think NEE or UNH mentioned in the analysis. Fed Governor Collins even talked about productivity gains from automation, which feeds that AI narrative.
And which sectors are feeling the pressure?
Mostly the rate-sensitive ones. Things like real estate, some consumer discretionary areas. Macy's got to mention high-yield bonds. They don't fare as well if borrowing costs stay high for longer. Even regional banks like Truist are watched closely for default risks if the economy slows.
So it's this kind of squeeze between quality growth in tech AI and defensive value elsewhere.
Yeah, that sums it up. And any news affecting AI sentiment, like Nvidia's report or anything shifting Fed expectations, will likely amplify those moves between the favored and pressured sectors.
The analysis briefly touches on specific stock rationales too. NVDA, Apple, AAPL, Abercrombie, ANF, SoundHound, SOUN, and GameStop, GME. Key drivers seem to be earnings for NVDA and ANF.
Right, earnings anticipation is huge there.
Tariffs in China for Apple.
It's still a major overhang,
The lawsuit for SO.
creating that near-term volatility.
And just pure meme stock dynamics for GME.
Exactly. Sentiment and speculation driving that one much more than fundamentals.
And there were identified conflicts in the analysis for these technicals, saying one thing, sentiment another. What's the implied path forward, considering the tariff delay in these catalysts?
Well, the tariff news helps sentiment broadly, but these specific catalysts are likely dominant now. So pre-earnings caution for NVDA and ANF seems wise. Apple remains sensitive to any trade headlines. SOUN is highly volatile around this lawsuit deadline. And GME, well, it's GME, high volatility, momentum driven.
Okay. And the analysis even lays out some bullish-bearish scenarios and action plans for these stocks. What's the overarching strategic message?
Caution and selectivity. That really comes through. With major earnings like Nvidia and ANF and that SOUN headline, maybe waiting for the dust to settle makes sense for some.
Don't jump the gun.
Right.
Yeah.
Apple needs constant monitoring on the trade front. GME is purely speculative. The analysis likely ranks trade setups based on risk versus reward, suggesting a balanced approach. Don't chase everything. Be mindful of the risks, especially this week.
This has been super helpful, really unpacking the layers in this analysis. It clarifies those opposing forces, inflation versus Fed, growth versus value, tariffs versus earnings.
It's a complex picture right now.
It really is. So for you listening in, the big takeaway is just how dynamic things are. Macro factors, geopolitics, company specifics, they're all intertwined.
And understanding those connections is key.
Definitely. So a final thought to consider. How might these short-term rotations and pressures we've discussed, the focus on AI, the defensives, the rate sensitivity, how might that influence your longer-term thinking about your portfolio's exposure? Are you positioned appropriately for ongoing tech evolution, trade uncertainty, and potential rate shifts?
Good questions to chew on.
Absolutely. And if you found this deep dive useful and want to stay plugged into this kind of analysis, make sure you subscribe. You'll get the fastest updates on future deep dives.